Come grab a chair up close. We're gonna get started. Come on.
Nathan's got
Oh, Nathan has his, what? Nate, that's my downfall, is put a baby on the screen.
And it's distraction.
Yeah, right. I can't hear you, but I just want to see the kid. So
I couldn't reach
super cool.
Good morning.
It's not very big, and he's kind of in the shadow. Oh, he leads us. There he is. Yeah, grandbabies are awesome. Cool, Nate. Thanks. Are you licensed in another state?
No. I was.
That's right.
It's easy for me to get back.
Nate just left.
Right.
No, I'm kidding. Okay, we're gonna get started. Jason has been here before. I'm gonna actually have you come up and introduce him too. One of the things I like about what we do here is I get introduced to people that, yeah, go step back down, Michelle.
No.
I just did.
I can turn this around. Right, your face. But every once in a while, my agent or somebody that I know that is important in my life will say, dude, you gotta meet so-and-so, right? And so that's how I met Jason, is Eric says, you gotta meet Jason. So I'm gonna let Eric actually introduce him. So I'm glad you guys are here. Yeah, I'm just gonna turn it over to Eric. Eric, introduce.
Awesome. Well, I'm excited for Jason to be here. Thank you for giving us some education. I know it's going to be fantastic. You see Jason is the Lone Wizard. It is not just a cool nickname, and it is actually the truth. So I met Jason maybe a year and a half ago. Was it probably about that? A year ago. And Michelle and we've done some transactions together. He's been awesome. But on the very first transaction that we met, it was actually some clients of ours that popped in an open house, and we kept in touch with this couple that were moved from California to Draper. And about 6 months later, we did a seller finance on a property for them, because they had some investment properties and a bunch of things going on, a bunch of moving parts. So we did a seller finance instead of a traditional close. So when they were looking to refinance, they were going through a bunch of challenges, because they had, just some investments, they had a business, and the loan officer they're using was really struggling. And someone recommended to them and said, hey, you need to talk to the loan wizard. And they're like, who? So they did, and I think Jason got their whole complicated, difficult file done in less than 2 weeks. And so when I heard that, and our client said, hey, you should really meet him, I said, I would love to meet and talk to this loan wizard. I mean, that is fantastic. So we got together and we've done some transactions, and he's been just awesome. So, and become a really good friend. So we appreciate him being here. So thank you, Jason. And also you do some acting and some performing arts type things. So I'm expecting a fantastic presentation.
No pressure. No
Do some of your
Your
skills.
little,
Come on up, Jason.
awesome.
Yeah.
Okay, guys, for those on Zoom that don't, oh, hi, Brianna. I can't see everybody on there. Bree's down in Mapleton. Good to see you. We do these every week on Thursdays because we want to introduce you to people like Jason. We also, in person, when you can come in person, we get the opportunity to have a sponsor. In this case, it's actually Jason that has sponsored his own presentation with lunch. So one of my favorite parts is, unfortunately, as I say goodbye to you guys on Zoom, we get to stick around here and have lunch and kind of network and mastermind, get to know each other a little bit better and build those relationships. So that's a real awesome part for me. So Jason, I'm going to get the clicker to your first slide here.
Okay.
Ooh, mystery. Oh,
yeah. Don't click yet.
No more.
All right.
Okay, cool. Thanks.
All right.
Unmute yours.
I did.
You already? Okay.
Yep, I just
turn
did.
this one off.
Yeah. So thank you guys. I appreciate that introduction. Sorry, no dancing or singing today, but hopefully you'll be entertained. So I'm Jason Karp. I'm with Revere Home Loans. It's a mortgage broker. I've been in this glorious industry for 26 years, and I've seen lots of ups and downs in the industry, the crash of '08, and a lot of government regulation changes, a lot of underwriting changes. And, unless you make a constant effort to stay on top of all the changes that are happening, you're just not going to know what's available to your clients and how to get them qualified for a home. So my hope for this presentation is to spark some ideas in you that'll hopefully you can take and apply them in your business and find more buyers out there. So this wasn't part of my original presentation, but after Emmanuel did his presentation a few weeks ago, I thought I would share my transformation recently. I went through, well, I'll show you.
Well, you led with change. That's where you're going.
Yeah. So when I was 19, I went in the Army, and I was in pretty good shape. There were, the first day, I was in college, I was in ROTC, and I was in the Ranger group, and so did a lot of running and a lot of fitness. And the first day of basic training, the drill sergeant said, "Who here can do 50 push-ups?" And this is out of 60 guys, only 4 of us raised our hands and could do it. And they said, "Okay, you guys are my squad leaders." Like, oh, okay, that's pretty cool. I felt pretty good about that until I found out why. And that's because when anyone in our squad screwed up, we had to do push-ups with them. And so, yeah, but I was in what I felt was a great shape at the time. I cut out the other guys because they were actually in better shape than I was in this picture. But so then, and then I got married, and my priorities changed, and admittedly, I was not making a happy face in this picture, but started to put on some weight. I got married when I was 25, and or excuse me, when I was 23. So this is 5 years after getting married, and then 35, putting on some more weight, kids and all that stuff. And then 47, just 2 tons of fun. And I had tried all these programs throughout the years, Body for Life, P90X, all these things. And my weight went up and down and up and down. And it's kind of between 265 to 285 for 20 years. And when I turned 49, I remembered that my uncle, when I was younger, and he turned 50, he got in the best shape of his life so that he could play competitive tennis. And even into his mid-70s, he was beating people in their 50s at tennis. And that was really inspiring to me. So when I turned 49, I said, by the time I'm 50, I want to get back to my marriage weight. So I was at 270 at the beginning of the year. And then by the end of the year, I had made it to 235 by my birthday. By the time I turned 50, I made it back to my marriage weight. I had signed up to do a Spartan race. That kind of helped me to stay on track. And then I had my birthday goal. And then I signed up for some sprints at the Utah Summer Games last year, and that kind of helped me on track, and I just kept going. And so finally, at the age of 50, I got in the best shape of my life. And you can see, like after decades of struggling, I went with eat right and exercise, and it just little by little consistency made lifestyle changes, and it led to Mr. Happy Face. I put a little color in my beard to attempt to look the age that I feel. So hopefully that works. But
Congrats, man.
thank you. Thanks. So that's at 220. So from 270 to 220 in a year and a half. But I'll just add that whether people realize it or not, they're more likely to pick to work with a realtor who appears to have their health in check. You can say have their shit together. To manage their health successfully is what I put. But okay, so now to the Brainiac stuff. Okay, so some tips and tricks. this first one, I don't know if you know about, but a parent can buy a home for their disabled child, or a son or daughter can buy a home for their aging parent. Now, when would you use this? Well, let's say someone has a parent that dies, and the parent remaining doesn't want to take care of a home that's too big for them. So, but it's not going to be a lot of years before they're maybe in a long-term care facility, but they're not ready to go in yet. So what this program allows is for, say, you to buy a home for your mom, small home, HOA, everything gets taken care of. Maybe you get some in-home health care, and you buy it as a primary residence, but she doesn't get added to the title, because when she passes, you don't have to deal with probate stuff, or and you just turn it into an investment property when she goes into long-term care or passes away. And so it just enables you to put 5% down, get the best conventional rates. As a primary residence, you are considered the primary occupant, even though you don't ever occupy the property.
I didn't know.
So this is great, I think, for financial and estate planners. You go, hey, look, they're dealing with aging people all the time. What's your plan? And this is a way you can also. All right. You can increase your investment portfolio, but do it in a way that is beneficial to many parties. And that's a fairly recent change, the last couple of years, but pretty recent. And then the same thing for a disabled child. So
5% down.
It's 5% down, and it appears to be usable for 2 to 4 units.
Yeah, I have a disabled niece. I'm like, maybe she can live with me for a while. Yeah.
Yeah, so and 2 to 4 units too. They can occupy one of the property. So I have a disabled brother, disabled for life, cerebral palsy, and my mom he's 56. She could buy a home for him, same situation. She's the primary occupant, even though she already has a home. And he can live in it, but it doesn't go in his name. He doesn't go on title, because if it did, it would screw up his Medicaid benefits. Right? He wouldn't qualify for that. So it's just a great way to provide primary housing for a loved one in this unique situation. And
Is it always when one parent passes away, or is there a guideline? Could it be for both?
no, so actually the guideline is, and I wrote this down, it's parents who are unable to work or do not have the sufficient income to qualify on their own. So both parents could be alive, they just don't, they're retired, they don't have income.
So that was an or
To buy them.
situation. Either they don't work or they just don't have enough income.
Yes, well, we do have to prove that they can't qualify on their own. Yeah. Now, even though we have programs for assets, if they have a lot of assets, that's not into consideration. It's income. Can they afford a payment? No. We show their taxes that show they're not receiving enough income to qualify, and then we can use this program.
Any pricing limits on purchase price?
So it's a conforming loan limit, conventional. So 766,000 right now. Any other questions on that one? Okay.
So did you have 2 FHAs technically? Like if I had an FHA, could I buy a property for a parent?
So this is a conventional program, not FHA, but FHA allows for you to have a second FHA if you are a non-occupying co-signer on one. And so if you co-sign with someone on an FHA loan, then you can go ahead and buy your own on an FHA loan and have 2 FHA loans that way. Otherwise, if you have an FHA loan, the only way, and it's your primary occupancy, the only way to get another one is if you move, you have to show all these reasons why you can get another FHA loan because it's considered down payment assistance in a way, 3.5% down. So, yeah, does that answer your question? Okay. So another fun program that is a fairly recent change, 5% down on 2 to 4 unit primary residences. So they occupy 1 unit. And then they receive rents from the other 3. Those rents can be used to offset the payment for them.
After a certain period of time or initially?
No, right away.
No G around.
Right. Yeah. Yeah, they don't have to have landlord history for this. And they can, yeah, the rents can offset the payment entirely, you know, ideally.
Compared to other income producing.
Yep.
I don't know if that's an option at all. That's a separate bullet point from the previous item.
Yes, these are separate.
Yeah, that's huge.
Yeah. Yeah, it's huge. Like, it's amazing. You can, I mean, that's how people are house hacking now. Get into a 2 to 4 unit, their first home, and then they move and get their next home and they've got this nice investment property. So on FHA, a buyer can borrow 100% of the down payment. So you might say, well, there's there's all these down payment assistance programs that allow for that. Great, but they can borrow it from family. So when we use a down payment assistance program, let's say for example, Utah Housing, which is a great program, their interest rate right now is 6.875%. And then they get their down payment of 3.5%. They get that at a rate of about 8% is their cap. So on this program, though, they can get a regular FHA rate, which I just locked in an FHA rate at 5.875 the other day, with only half point, like really cheap money, relatively, right? Yeah. And so, and a lot of times, they can get a gift from family, but sometimes they don't want to do a gift, or the gift, so like, yeah, here, we'll gift you, but you owe me, right? You got to pay me back. And they have to sign this letter that says they don't have to pay me back. And sometimes they're like, but they do have to pay me back. So FHA allows for them to borrow the money for that. It's pretty cool.
Without disclosing the terms of that loan, if it is a loan, right? There's no requirement to.
They do have to provide the promissory note.
Okay.
Yeah.
It's not yet.
And there are parameters. Well, it is a loan. We're borrowing it, so it is a loan. And there are parameters. You can have a balloon within 5 years and that kind of stuff. But
It's not going to upset the movie. That's just great.
yeah. Yep. Exactly. Okay. Conventional, we can do borrowers with no credit scores now. And it used to require at least 1 score. Now, no credit scores. A couple of caveats. The automated underwriting system, AUS, has to approve it, or else if it doesn't approve it, then we have to do alternative credit, like show their cell phone bills and their insurance payments. So, show a history of credit that's not on the credit report. And but if the AUS accepts it, like if they have enough in assets, then sometimes they won't care about the credit history and it'll approve it. And you don't have to go through all that rigmarole. So just because you have a new buyer that doesn't have credit, might still be able to get them a loan. All right. Any questions on any of that stuff? Sorry.
Great talking to you.
Okay.
Great talking.
Okay, I'm sure you've heard of the 2-1 buy down, 3-2-1 buy down, and the 1-0 buy down. So I have a calculator, which I will send to you if you're interested in it, that will help you to know, okay, if I'm a listing agent, then to attract buyers, I'm going to advertise that there's a free 2-1 buy down. So instead of 5.875%, you can start out at 3.875% on an FHA loan. And this will show you the cost of doing that. So you just plug in the sales price and then a loan amount, and it'll tell you how much that's going to cost, and percentage-wise, what percent of the seller concessions would that turn into. So when these first became popular, the 3-2-1 buy down was all the rage. It was like, wow, you can get, because rates were like 7.5, and so you can get a rate of 4.5 like you're used to. But you can see it's really expensive. So $21,500 on a $480,000 loan amount, and that's 3.8 of your concessions, which can be a problem, which I'll show you in this next slide. Any questions on this? It is a great way, I think, to advertise people. You can show them the payment is, for the first year is going to be, the principal and interest payment is going to be $2,400 versus $3,000. So, because a lot of buyers are payment oriented, right? Or yes,
settle into their new life. Yeah.
Exactly. And so they need to qualify at the higher rate, but if they can see, they're wrapping up their schooling, or they are confident they're going to be making more money in the next year or two, then it's a great way to enjoy a lower payment, especially if the seller is willing to pay for that for them. In my opinion, if the seller's not going to pay for it in concessions, it's not. I probably wouldn't do it. I wouldn't advise a buyer to spend that money up front, because it's just the interest that is saved over the first 24 months up front. Why would you do that? Unless you got the money from somewhere else and that allowed them to enjoy a lower payment in the meantime. But yes, okay. Now, a better way to lower people's payments, in my opinion, is to buy out the private mortgage insurance and PMI. So seller concessions can buy out the PMI. So say someone puts 5% down or 3% down, there's a monthly mortgage insurance payment, right? And there's also an option to do a lump sum to pay that upfront. So, for example, you have a $525,000 purchase price, 95% LTV, 740 credit score. The P&I payment is $3,284. The MI is $120 for a total of $3,405. Now, I can't tell you how many times I'm like butting up against the 49-50% debt to income ratio mark. Like, so often, it's crazy. And so people, like you said, they're stretching to be able to qualify because they want what they can afford, and it's usually like, okay, what's the max that I can get qualified for? So that the PMI payment could represent, if bought out, could represent 2% in DTI, or in other words, $18,000 in purchase price. It allows them to qualify for $18,000 more. Because it's so often that I say, okay, you're approved for $450,000. Great. And then they come back. Oh, we saw this house we really like for $465,000.
Yeah.
But I told you $450,000 was the limit. Like, it's the limit. I mean, if I tell you it's the limit, it's the limit.
Yeah.
And then I have to try and figure out, oh, wait, maybe if the seller's willing to buy out the mortgage insurance, then I can get you qualified for that house. So the cost to buy out the MI in this case is $8,500, which equals 1.6% in seller concessions. And versus using, sometimes they want to buy down the rate, permanently, long term. Well, the cost to buy down the rate to save $120 a month, which would be 3/8 in this case, would cost $11,000 or 2.1% in seller concessions.
The 1.6 version, it tails off at some point in the future. Why is there a permanent buy down versus the?
Right.
In the 8500 version.
So the 8500 version, it buys out MI. There's no MI for the life of the loan.
Regardless, okay.
Right. Now in this case, they're buying down the rate.
Oh, you get That 120.
to save, yeah, to save the 120 so they can qualify for that home before 65 or whatever. It's just a less expensive way to qualify for more. Does that make sense?
If you're in a market where seller concessions tend to be the norm, and that's.
Yes.
You can get done, okay, I love
Yep, exactly. Yeah. So yes, get more for less, buy out the PMI. Now, this will change based on LTV and credit score, the main factors on mortgage insurance rates. Now, I'll piggyback on that and say, so Revere Home Loans, we have the lowest rates of any broker that I know, the lowest margins of any broker that I know. And when compared to, so last year I worked for Supreme Lending for the 7 years before that. And I got to a point where I had priced out with Will, the owner of Revere Home Loans. And on a $500,000 house, he was $7,000 cheaper than my rate. Because I had lost 3 deals to brokers in the last 2 months prior to this. I'm like, okay, help me understand why, broker rates are so much better than lender rates right now. Why is that? I don't know. It's not usually that much of a wide disparity, but it was last year, and there still is to a large degree. And of the brokers out there, my company is the cheapest. So why is that important? Because you can see the difference in that 0.3% in rate can make. It can save these people trying to ask for 11,000 in concessions to qualify for a permanent buy down or whatever. So low rates has the same effect. And if you double up, all the better. You can qualify for a home that's $36,000 more, whatever. So those are ways. Any questions? Great. So seller concessions, you may already know this, but I thought I would include it. And if you'd like me to send this to you, I can send it to you. But basically on conventional loans, if the LTV is above 90%, then 3% is the max in seller concessions. But if they have 10% down to 75 LTV, 6%, and then if they have 25% down or more, 9% concessions. You can go crazy with all the buyouts and pay, if you want to. I never see anyone do that. But it's also important to know that on investment properties, it's capped at 2%. So if you are buying a property and you expect the seller to pay for a bunch of concessions for you, it's going to be capped at 2%. And then FHA allows for 6%, VA, I'm going to say USDA 6%, VA is 4%, but they don't include closing costs in that. So that 4% is a cap on what the sellers can use money for other stuff, like paying down the veteran's debt to qualify. So the closing costs are not, the seller can pay for closing costs. It's not included in this cap. The seller can also, pay down the veteran's debt to qualify.
So it's closing costs and then 4%?
And then 4%. Correct. Yeah.
That's, could be a deal maker. I mean, that could be the whole deal right there.
It could. Yeah, for sure. Okay. So seller concessions, when you ask a loan officer, okay, I'm going to submit an offer, done this pre-approval, what are closing costs? How much should I ask for in concessions?
And yes, please ask before writing an offer.
Yes. And I'm going to show you how this is a moving target, and to not blame your loan officer if they're very far. Well, you can blame them if they're far off, but we can get it pretty close. But I'll show you this one first. So depending on what the rate cost is, can affect it, because we can't lock them in until they're under contract, and that's what makes the application date. And then I can lock them in, and then I know what the cost of the rate is going to be. It's actually interesting. Credit report, we do rescores all the time, but we can't actually charge the borrower for those. And sometimes it costs us hundreds of dollars. So if you have a loan officer that's willing to do credit rescores, just thank them because it's coming out of their hundreds of dollars out of their pocket. So appraisal, we're getting a lot of appraisal waivers lately, and I'll show you a grid on when you can hope for that. And so you might save, $550 on an appraisal. And if I tell you a number up front, but I don't know that again until I have a property address that I can then run in the system and find out, hey, we got an appraisal waiver. So I might give you a number, and then in the end, it might be $550 less because now we don't have an appraisal. Like, why did you overshoot it? Well, because we saved $550. Sometimes the borrower's like, oh, you know what, I'm going to be out of town on that date. But they don't tell you that until later. Well, now I have to tack on a $200 mobile notary fee, something like that. Homeowners insurance premium, we don't know that until they get a quote from their agent on that particular property. Prepaid interest, depending on the day that we close in the month, that'll vary. Property taxes, we won't know until they find a property and what that is. And if that property has HOA dues, transfer fees, upfront dues, that kind of stuff. So that can all vary when you ask us, what are closing costs? I try and play it safe, and if you have an MLS listing that you can send me, then I can really narrow this down. I can target it much better. So yeah, when you ask, hey, I'm going to make an offer on this house, send me the MLS. I can figure out the property taxes. I know if there's an HOA. I can figure out a lot of this stuff. And then, and I just wanted to show, just to brag a little bit, I told them in this is a real closing that took place. I told them, ask for $10,000 and sell concessions, which they got, and we ended up at $10,056.
Nice.
Any questions on that? Great. Appraisal waivers. Just a couple of things I wanted to point out. This is the grid of basically when you can hope for an appraisal waiver. And I can send this to you too if you'd like. But principal residences, second homes, if the LTV is 80% or below, refinances 90% and 75% on investment properties. And cash out refinances 70 and 60%. Now, but be aware if there is an ADU with rental income that we're using to qualify, it then disqualifies them for an appraisal waiver. Or if a property is identified with adverse physical conditions per the sales contract, property inspection or disclosure by the borrower that indicate an appraisal should be obtained. So I bring this up because sometimes I'm super excited, we get an appraisal waiver, we save time, we save money, and I let you know, hey, we got an appraisal waiver, awesome. And then they get the inspection back. I'm like, oh, well, we want them to do this and this and this. Okay, but if you put that in a contract, I might lose the appraisal waiver. So, let's talk about this. Let's do an addendum. Let's talk to them and say, okay, let's do an addendum for, 2,000 more in seller concessions. But let's not put because of this, and this, and this. Yes, right. Now, if you want that, if you have fixes that need to be done and you want to put that in a contract, great. I just need to know so I can hurry up and order an appraisal in this case. Now, I have a lender that if it's 80% LTV or lower, conventional, W-2 borrower, appraisal waiver, they do an 8-day close. Yeah, it's awesome. Like they'll underwrite it. If I submit the file by 3 p.m. one day, they'll underwrite it by the end of the day. Yeah, so it's awesome. So I say 8 days because legally we have to wait 8 days. But in reality, if I have them pre-approved, I have got their documentation. As soon as they go into contract, sign disclosures, I can submit that to underwriting. I can have an underwriting approval in 2 days. We just have to wait. Yeah, we have to wait for the loan estimate, the CD, and that. But it can be a way to secure a contract. If you've got someone that's pre-approved with me, and I know they're putting 20% down, and you want to submit an offer on a property, give me that address. I'll plug it in, see if we get an appraisal waiver, and then you can submit that offer with, yeah, a 10-day close, or whatever. Assuming that it's vacant or the sellers, all that.
So.
Yeah. Yeah. So certain circumstances, yes.
You guys are you able to hit that because you guys are funding these yourselves and, so, I mean, how is that possible? Because that's damn.
It's because I have a wholesale lender relationship that prioritizes those cookie cutter loans basically and says, yep, we're going to do these quick. It's so easy for us, because as long as the information in the application is accurate and we run the AUS and it shows you're approved, all the underwriter has to do is go, oh yeah, the pay stubs support that, yep. And yep, it's like, yeah, it's really easy for them. So what if you get a property that comes back and you need some fixes and they don't want to get it done before the end of the contract? Escrow holdback is an option. So there are limits, and actually each investor is a little bit different, but these are Fannie Mae guidelines. And basically, it's eligible if the item is weather related, for example, exterior painting, pavement installation, stuff like that, or temporary building material shortage, or if it's a bank-owned property, or if it's new construction, the landscaping, we can hold in escrow after close the amount to finish those items. But if it's cosmetic, if it's cosmetic, it's a no. It's like, oh, well, we want to do carpet and we're going to save, put aside money in escrow to replace the carpet because we just don't like the carpet. Yeah, that's not an option. So ineligible scenarios, incomplete items that adversely affect safety, soundness, and structural integrity, property inspections and repairs not required, in this case by the lender. So in order to hold money in an escrow holdback, we have to have the appraiser say, this needs to be done in order for financing. So if it's not on the appraisal, we can't hold it, do an escrow holdback for it. It has to be done prior to close. And then the maximum amount of the repair cost can exceed 10% of the appraised value. And then for this is for UWM, but they'll allow 180 days to fix those items. So if you're in the dead of winter and stuff just can't be done until it warms up, they'll allow for 6 months out, which is actually really generous. When I worked for Supreme Lending, they were 90 days and that was it. But any questions on escrow holdbacks? Okay. Okay, some unique programs. Maybe this will, do we need to do a little video? Okay. Now, are we excited for DPAs? Woo! So Utah Housing, I mentioned, 100% financing. They have FHA and conventional options. If you have a home that's just not going to go FHA, for some reason, it's an old house and what have you, they do have an option for conventional. It does require a better credit score. Rate's a little bit higher, but it is an option. Nice thing about Utah Housing is they have higher income limits than your normal DPAs that go off of the AMI, the average median income. And right now they're doing a $20,000 loan for, it's a second lien on new construction to help buyers buy new homes. You have to be first-time home buyer on that, but they're encouraging them to buy new homes. So $20,000, it's a silent second, no interest, no payments. It just goes on there and eventually he has to get paid back. Yeah.
buyer like resets at a certain amount of years, is that right? Like if you have a gap.
It does, 3 years. Yeah. Mhm. Yeah, so there's a question on our application. Yeah, there's a question on our application that says, have you owned a home within the last 3 years? If the answer is no, they're considered a first-time home buyer. They're doing, the new thing is a $25,000 grant for people in law enforcement, police officers and correctional facility staff. 25,000, it's a grant, it's free money, it's not a lien, pretty cool. I've got a lender that has a conventional 0% down option. They'll give up to 15,000. It's a silent second. And they either have to be a first-time home buyer that makes whatever income, or not a first-time home buyer and makes less than 80% of the AMI, which in Salt Lake County, I think it's about 86,000 is the 80% mark for the AMI. I have another lender who does, on an FHA loan, they'll do a forgivable 0% second for 3% down. As long as they're in the property for 10 years, that second mortgage is forgivable, it disappears. So that's kind of cool. Think about that, no income limits. They don't need to be a first-time home buyer, and they'll allow a 600 credit score for a DPA. This is very unique. I have another lender that does an FHA grant for 3.5% down, but there's no lien, it's a grant, it's free money, and the rate is higher on the FHA loan, but as long as they're in that for at least 6 months, they can turn around and refinance it, and they just have that 3.5% in equity immediately. No income limits if they're a first-time home buyer. Yeah, or if they're not a first-time home buyer, it's the 80% AMI limit. Any questions on these?
Yeah. The Utah housing for conventional, is that a 5% they do?
5% down? No, it's 3% down.
Oh, 3%. Okay, so 3% or 3.5%.
Yeah, right. But Utah Housing does the second for the up to the 100%. So the first loan is 97% LTV, and then the second loan is the other 3%. Does that make sense?
Yeah.
And it's reduced mortgage insurance. Instead of 35% coverage, it's 25% coverage. Saves them some money. Any other questions? Great. Oh, and then you have municipal programs that allow for DPAs. Like in Provo, for example, they've got one that'll give them their 5% down plus another 5%, up to 40,000. So they'll, yeah, it's interesting. I don't know how they came up with it, but they said basically, whatever the minimum for conventional purchase is, we'll double that up to 40,000 and just give it to you. It's cool, but the income and the price limit is really difficult right now to qualify. So
And you have to program.
yes, yes, that's the kicker. So municipal programs are great, but they're usually like needle in the haystack sort of approval. But if you have someone who doesn't make much money and there's a house that is not very expensive, there's your marriage.
It's still cool to know though, because they could have been looking at Orem or Springville, and it's like, hey, if you buy in Provo, we could make this work or whatever.
Yeah, yeah. Yeah. Okay, some other unique programs. So bridge loans, you're probably familiar with. I have some, they're different from each lender that offers bridge loans. So bridge loans, of course, are if you have a departure residence that you're not selling prior to buying the new home, but it's listed for sale, but you just want to keep it to, you know, not be rushed on your move, or you need to do some fixes or whatever it is. Bridge loans are a second mortgage that go on top of that departure residence to give them the money for the down payment on the new house. And they can use that money for anything. They can use it for fixing up the old house. They can use it to pay off debts. They can use it for, it's like a home equity line. They can do with it what they want. The kicker on a lot of them is on my inexpensive ones that are cheap, I do have to qualify the people on all the payments, basically. The first mortgage, the bridge loan payment, and the new home payment. But I do have one that's structured so that it doesn't affect, the departure residence payments don't affect the first, or it doesn't have to be in the DTI. And it is more expensive. It costs basically 2.4% of the sales price of the departure residence if they use the money. If they don't use the money and they just use the way that they structure the cash contract, is 1.5% is what it costs for that. Yes.
This may be a dumb question, I'm new, so it'd be nice. I have a friend who is in a contract that's her buying the house is contingent on the sale of her house. Is there any way to get that into a bridge loan instead?
Yes. So that is the purpose of this other one, the more expensive one. They basically create a cash offer on the departure residence that says, if this home isn't sold in 4 months, then we will buy it for this price. And it's a cash offer, so there are no contingencies. And Fannie Mae allows for, if there is a non-contingent offer on the house, then they don't require that to be included in the DTI on the new home. So, and what happens is,
So it allows your buyer to remove the contingency to actually become a way better looking project.
yeah, so now their offer is not contingent on the sale of their home because they have a cash offer.
In this case, they're already under contract.
Yeah, it's sometimes, yeah, I mean, you would know better than me, but is it hard to get an offer accepted when there's a contingency on selling
It's
the?
definitely hard.
I'm surprised there's one.
Yeah.
Because it's a variable, it's an unknown, like when is it gonna sell, are they gonna get the price they want, you kind of have to like research that as well. But I mean, it might be possible to remove that contingency based on the fact that you got a cash offer on it, even though they're under contract.
Yeah,
I'm not their realtor, but they've had it listed, I think, for like 3 or 4 months. Like they just, they have the other house, they know what they want to go to, but they just can't
yeah,
jump. That sucks.
yeah. So if they're having, and maybe, yeah, they're under contract and they have this contingency, but they're not able to sell their departure residence, they can take advantage of this program, get the bridge loan, and then they can qualify for the new one. They can get the money for the down payment, they can qualify for it, and they can still keep it listed at what they're trying to sell it for. But if in the next few months it doesn't sell, this cash offer has to be executed, but that company will then allow for the original realtor to keep it listed for another 4 months. And sell it, and whatever it sells for, if there's a difference between the cash offer and what it sells for, the original owner does get that difference. Yeah.
In other words, introduce your friends to Josh, have them help them,
Yeah.
and you'll be the realtor every deal they ever do besides.
Jason,
Like I say,
Josh,
oh, I do. I have
Jason.
to
Remember when
Yes.
we
You're good.
but yes, thank you.
Well done.
Renovation loans. So did you know that you could use a renovation loan to buy a home and build an ADU on that property? So yeah, that's cool. You get a lot of people like, oh, I really want a home with an ADU, or I need a mother-in-law or whatever. Like, okay, well, maybe we'll find a house that doesn't have that, but we'll get you a loan that allows you to build that. And now you have the best of both worlds. That's kind of cool. We have 90% loan to value on jumbo loans, and it's actually pretty good interest rates. They used to be 10% down. Jumbo rates were really high, and I have a lender that is really aggressive on that. ITINs, so people don't have a social security card, social security number, and they have a tax ID number, then I can get them to 80% LTV. You can use a reverse mortgage. Oh, sorry.
For for a jumbo loan, what is the minimum, what's the minimum of that? Or the maximum?
So the conventional loan limit right now in Salt Lake County anyway is 766,550. So anything above that is going into the jumbo realm. Now there are a few counties that have what are called high balance limits, Summit and Wasatch, I think Davis even this year. It changes every year, but they'll allow you to go higher and not kick into that jumbo realm. But jumbo will then go from that mark to whatever. Many millions. Yeah. Many millions. Although over 3 million is pretty hard to get financed. It's a niche kind of market. Yeah. So reverse mortgages, people who are 62 and a half and older can qualify for a reverse mortgage where there's no mortgage payment, and they can actually use that to buy a home. So it's kind of cool. They can get into a home and not have a payment for the rest of their life, and can work. The 40-year interest-only mortgage is back. Those of you who were during the crash, yeah, that was one of the hot items, but that one's back. And you qualify at the interest-only payment. So I wouldn't recommend it, but it's there. So we have a loan program on bank statement deposits. So if you have someone that says, I'm self-employed, I haven't done my taxes yet. I make a lot of money, I really do. I just, I don't like to report it to the IRS. So
this is feeling a lot like 2008. I can't believe
they're coming back, man. They're coming back. The Alt A.
that's why.
Yeah.
I did every one of those. That's why I'm amazing. I can do them again.
The only one that hasn't come back, and I don't think it'll ever come back, is the negative amortizing loan. And it shouldn't come back. It's terrible. So we can take the last 12 months or 24 months to get a better rate of their personal deposits or business bank statement deposits and use that for income. And then we'll evaluate the bank statements for an expense factor, minimum 15%. Or you can just say, don't do the calculation, and they'll cut it at to 50% of the deposits, and you're good to go.
What's the minimum time frame?
12 months.
12 months.
Yeah, 12 months. Personal or business.
So if you go 24, you said it's just a better rate.
It's just a better rate, yeah. It doesn't, the loan to value options are the same either way. It's just a better rate.
There's hope for all your friends to do it, right? Deposit their money with you.
Yeah.
Can you do those on jumbos as well?
Yes, there's some jumbo programs with that. I did have one get declined because he was a real estate investor and he only had, in the last 12 months, he had 2 large deposits that equaled over 200,000. It was enough income, but because they were sporadic and the last one was like 6 months ago, they're like, this isn't consistent enough for us to be comfortable with
So
this.
spread out your.
So it's got to be, yeah, you have to show some kind of cash flow in the business. We also have asset distributions or depletion. So when someone has a lot in the bank, we can, there are a number of different options, but one is we can take that sum and divide it by a certain number of months. And as long as that amount is enough for their monthly debt to income to qualify, then they're good. So if they have $1 million in the bank, divide that. Fannie Mae, Freddie Mac are a little different. I think Fannie Mae is 360 months, Freddie Mac's 240 months. But I do have the non-QM loans, you've probably heard of, that allow for, I have one that's a 74-month calculation. So maybe they only have, they have less, but I only need I can divide it by 74 months, and as long as that's enough, we can get them to qualify. And then another unique one is this, if they have 500,000 in assets, if we take their liability payments, so their mortgage payment, any car payments, whatever they have, and multiply that by 60, as long as it's not more than the amount that they have in the bank, approved. There's no DTI.
You know,
That's it. No tax
might be an
returns.
offline question. Do you know if cash value in a whole life policy counts as cash?
The stipulation is it just has to be liquid
It is.
and accessible, which would be, right?
Yeah.
So yes,
We can do those all day.
awesome. Yeah, it's great. It's like, yeah, if you have over 50 or over 500,000 in the bank, let's add up your liabilities 60 months, as long as it's under what is liquid. No DTI, no tax returns needed, no tax transcripts.
Any seasoning requirements for that amount that's liquid?
That's a good question. Probably 60 days would be my guess.
Sure.
But yeah.
We're getting Parker.
Dude, I've been out of the game. I've been out of the real estate game for a long time. This is awesome.
So DSCR, debt service coverage ratio. Most programs require a 1-to-1 ratio. So if you're not familiar with those programs, basically, as long as the rent collected on an investment property is more than the mortgage payment, then they can qualify for a loan. We're not verifying any other kind of income for that. I do have a lender that allows for an interest-only payment to be included for that amount. So the rent only has to cover the interest-only payment amount. So that helps a little bit there. And I've got one that is just coming out with a short-term rental income for that 1-to-1 ratio. So short-term rental, obviously, in most cases, is going to be higher. This is the estimate, is going to be higher than your annual lease. And so they'll use that for the marker of 1-to-1 ratio. And they'll use basically the appraiser's estimation of the short-term rental. So appraisers can either do their rental market estimate on long-term rents or on short-term rents. And so we'll go off of that short-term rental, which is
Which
kind of
means
cool.
that can be projected rent, not actual.
That's right. Yep, projected.
What does an interest rate look like on this deal?
So it varies among these all different situations, but it's basically high sevens is going to be the best. I priced one out the other day. It was 8 3/8 at the cost of like a half.
Discount point.
But you're basically, yeah, half point. But most of the time you're looking at 8s and sometimes 9s, depending on if it's a high loan to value, you're going to be pushing it up there. The 80% is the high loan to value. I think I might have won 85%, but the rate is not pretty. And so the chances of that rent covering that payment are not great.
So along with the ratio, is there LTV limits too?
Yeah, so basically 80% LTV is the max, yeah. So if they've got 25 or 30% down, all the better. You get a better rate and much easier to cover that ratio. I do have a lender that allows for a 0.8 ratio. So the rents only have to be 80% of the payment. So
Just pay a higher interest rate.
pay a higher interest rate, right? More risk, more higher rate. And then you can use a DSCR to allow for foreign nationals. Foreign nationals, there's just a huge realm of different things that go on there. But this one, they don't have to have US credit, they don't have to have US income, and they can buy a home here under the DSCR program, buy an investment property. So if you have friends in Canada or China or whatever, want to buy some investment properties, they can do that. All right. I can send you this grid if you want. Basically, do people ask you how much can I qualify for? I don't know. Do you get that question or? Yeah. So I put up this grid. I created this grid just to sort of be a target. Like, okay, based on this loan amount, this is an estimate of payment, PITI. So all of it in there included, but it doesn't have a potential HOA dues or, I'm taking an estimate of property taxes and all that. And this is no other debt. They need to have at least this much in monthly income to get a home for 600,000. With where rates are right now, they need to be making at least 8,400 a month.
Take home.
Gross. But if they've got a car loan for $600, then, then it's higher. So I created this so that you didn't waste a lot of your time
Great chart.
or my time, really. So if you've got,
Close, then have a conversation.
yeah, right. So if it's close, send them my way. But if they want a $700,000 house and they make $5,000 a month, like, no, I'm sorry, we're going to have to, lower your purchase price expectation, unfortunately, to, half that. And yeah, that's just where things are right now with where rates are. Yeah.
Have an investment property that's being rented out, how many payments do you need to qualify, to use that money to qualify? Like if you have yearly renters, is it a year's worth of payments enough to have that income qualify?
No, so if you have an annual lease in place, we'll just take that amount. Yeah, if it's not on the taxes, there's no time frame as long as you have an annual lease. So, I mean, when if someone's buying an investment property, and there's an annual lease, we'll take that amount. Or if there's not a lease, we'll take the appraiser's estimate. And if they're doing a refinance, then it if it's not on the taxes, they'll take the lease amount. If it's short-term rentals, it'd have to be on the taxes for us to include it. If that makes sense. Any questions on this? Okay. All right, so do you get the objection? I don't want to jump to a higher payment or a higher rate right now. I'm just going to sit tight, wait for the market to change. So a couple of possible solutions for those people. People have a lot of consumer debt. It's just, more and more things cost more. And so they're racking up their credit card debt. Sometimes, if they have, in this scenario, I just put, they've got a current mortgage payment of $2,000. Oh, well, I can't buy anything and have a $2,000 payment. But they're paying $1,500 in car loans, credit cards, what have you, the car loans aren't going to be a super high rate, but their credit cards are definitely going to be high rate. Well, that's as if I can pay that off if they sell their home, use their equity, pay off their debts, then they can have a $3,500 mortgage payment. It's the same as what they're paying right now, but they can get, maybe a house, a house or a nicer house, or convert the primary residence into an investment property. Maybe they're enjoying, their objection is rate. Well, I don't want to, pay a higher rate. Well, if their current mortgage is $2,000 a month, but they're able to rent it for $3,000 a month, that $1,000 a month difference is as if their new home rate is 3% lower than the market without losing their equity. So if I take that $1,000 against their payment and kind of, backwards into a number, it's as if instead of 6.5% rate, it's as if they're paying a 3.5% rate because they're getting this extra $1,000 a month. Does that make sense? Yes.
What are the negative sides to debt consolidation? Is there a penalty? What's the bad part about it?
The negative part is that you're putting this shorter term debt into a 30-year loan. But that's it, because chances are that consumer debt is at a higher interest rate. Now, if it's credit card debt, if people are making minimum payments, it's 20 years anyway. So, and at 20, 25% or whatever it's at. So when it comes to credit card debt, I would never shy away from paying that off. But if it's a car loan that only has 2 years left and it's at 6%, I might shy away from that, from paying that off I mean, he's probably better to answer this question than I am, but that would be my recommendation is if it's credit card debt, put it in the mortgage, close your credit cards, or if they're disciplined, just use it a little bit. But yeah, unfortunately in the heyday when rates were lower and people kept refinancing, they kept racking up their credit card debt and all right, let's refinance again. And
It was like boat and but other stuff they shouldn't have been financing.
yeah,
So the answer is,
but
some
Yeah.
that is worth consolidating.
Yeah. But help people to understand that they can, even with where rates are right now and the market, it's as if they make the right choices, it's as if they can take advantage of the new stuff and it makes sense for them financially.
And I'm just gonna make a comment, I'm not presenting, but as a new agent, I made this mistake as an agent, I was an agent for, well, still an agent, but anyway. I viewed myself as a real estate guy, not as part of their financial team. And that was a huge, my detriment and to theirs, right? I was like, I don't know, talk to when you know just enough to be dangerous, like you're like, I don't know, debt yourselves might make sense. Let's go have a conversation. And you sit down together. You're now a member of their financial team. Like you are together having this conversation, you're bringing value, like that's valuable. And so then if you have a conversation with a realtor who doesn't know about their financial stuff and they have debts, you bring in a financial guy, now you are bringing so much value to these dudes. They will do every deal they ever do, like they will. And so you don't have to know if the debt should make sense in this example, but you need to know that it could make sense, and then just get the conversation started. I think that's a new agent.
Yeah.
If you're just walking around, I mean, Jeff's big in this, creating value for people, but if you're just walking around finding ways to be valuable for people, oh, and by the way, you can help them with their house, that's a way better deal than leading with, I can help you with your house. Right.
Whether they say it or not, they're counting on you to give them options that they can't think of on their own. They don't know.
They don't know, they don't know it.
So you need to know enough about this, like Parker said, to open the conversation and then bring in Jason and say, let's take a look at what your scenario would look like based on your income, because they're bringing up the problem. There might be 3 or 4 solutions. They don't know what it is. They're just thinking, oh, I gotta sell my house.
But yeah, you take someone to Jason and Jason brings someone like me, you get credit for 4 different people's value we brought to the table, because that's the chain of events you started. So I'm just saying in general, you love that too, right? You love
Yeah, absolutely.
Like,
Yeah,
you're just like,
sure.
I don't know, this dude has money, I just don't know how to make it work, or okay, bring him in. You can,
Yeah.
You're the guy making it work compared to the standard lender handcuff dude that doesn't have any options, right?
Absolutely.
So we just need to be bringing options to the table, so this is.
For sure. Okay, I know we're running out, so I'm going to show you something that I got recently, and I love it. So I got this. Basically, I go to the closing table, and I ask them, "How was your experience? It was great. Any ways, things I can do to improve? What'd you think? How'd you get? Oh yeah, it's great. Everything went well. Great. Would you mind leaving me a review? Oh yeah, sure." And well-intended as it is, they never do it. Yeah. So I say, okay, great. Get out. Yep. Take out your phone, get out your camera, and this QR code takes them straight to their Google profile to leave a review. Boom. Great. Would you mind saying what you just told me in a review for me? Oh yeah, sure. Just do it right there while we're waiting for the title guy to, wrap up make copies, do it. And boom, it happens instantly.
Nice.
So, or they can either do the QR code or it has the NFC if you want to get technical, but people, it's just so much easier, I think, just to do the QR code.
I've also seen them on your phone. Is that like a thing now?
He's gonna
Yeah.
talk about it.
Oh, great, perfect.
So, and then they also have so the company I recommend, I researched these and found there are a lot of ones that do the NFC thing, but I liked this company because they also had the QR code on the back, and I find that that's easier for people. So trusthero.store is the website that I use for that. They have it's for all kinds of businesses. So they've got like Yelp cards and all this stuff. But I know a lot of agents, they want the review on Facebook. That's where they do most of their social media. So they've got a card that links to their Facebook, ties people into their, their Facebook to do a quick review that way. So if you don't want Google, you do Facebook or a number of other things. But highly recommend that because, and then I show my friends like, hey, check out this thing I got. Here, pull out your phone. Oh yeah, Jason really knows his stuff. He's great, you get like, if you want to build your reviews quickly, get one of those.
Super.
Okay, where was I? Here we go. And then if you want to do promotional items, my wife works for this company, naturaltrends.com, and they label various products for companies doing events. If you're going to do a big golf tournament or some sort of big social event, their big thing is they have these Tide pens where you're like, you just get a stain and you just. So I think they have an exclusive contract with Tide for those. So if that's your thing, this is a great company. They have WD-40 pens. You hear that squeak in the door, you just get out your WD-40 pen, that Jeff Marchant got for you, and it has your name on it, and you
You're
just.
right, that's way more achievable than like a shitty pen.
Yeah,
Right, like
yeah.
that's action, people will keep that in
Yep.
their yes, that makes sense.
Exactly.
Good stuff.
So if you want to do promotional items, there are parades this summer. If you want to walk in the parade, handing out stuff, I mean, that one would be an expensive one to hand out, but anyway, they got all sorts of stuff. And then networking, local chamber of commerce, trust integrity. I mean, you guys know all this stuff, but Pitch 59, I'm sure you've all enjoyed presentations from Jeff on that.
Had a conversation with me then.
But these are great ways of networking. I joined a trust integrity group. I like it a lot better than BNI. It's business owners who are just sharing ideas on how to improve their business. There's a lot of contractors in those groups. And yeah, I like that one a lot. Chamber of Commerce, first time I went, sat down next to someone, talked to this woman. She wanted to, she's thinking, oh yeah, I'll probably buy in 6 months or whatever. And I said, well, do you, let's talked about some things, realized, oh, well, you could get approved now. And they said, oh, I thought I needed to save up money. And this is someone that did this grant program that I mentioned earlier. They're like, oh, well, instead of waiting to compete with all the other people during the spring, summer, we'll lock down a house now. Yeah, it's higher rate, but they got this grant program. And then instead of saving up for 6 months, they got in a house right away. And yeah, so I would recommend find more buyers. Just go to these things and talk to people because you just never know. And they don't know. And they don't know that they can get a house right now, or they have all these, misconceptions. So won't spend any time on that. Promotional videos. So this one is supposed to go to my Pitch 59. I have the Home Loan Wizard introduction video. Yeah, that's it right there. My recommendation, if you do a long form video with lots of content, you just want to get it all out, then take snippets of it for your short form social media, weekly update or whatever. You can record it all in one time, and if you want some help with that, I can help you with that. And I've got a friend who will also help. So for attending this class, being a part of this class, you get a free promotional video for your next listing, compliments of my friend Spencer Scanlon. And you get help with assistance on creating a self-promoting video for your business that introduces you to your clients, like mine. If you want help with a Pitch 59 video, I can help you script it with my theater background and all that stuff. Yeah, that's where it helps.
You loan out your hat.
And no.
That's mine.
And a professional video that helps you, and I explain the home buying. Oh, yeah. So I'm working on a video to help people understand the home buying process. And so I've got the lending piece, and you and I could team up for the realtor piece, and we can make a nice seamless video that.
Have you explained the home?
Yeah, but I want to do something like with my video with graphics and make it really interesting for people so that when they're looking at, okay, which realtor do I choose? It's a great impression to go, look, I'm going to help you like no one else is going to help you. And here, watch this video.
Nice.
And it just gives, an opportunity to really put forth why you're special and stuff. So I can help you with that, and I'll send you the temporary buy down calculator if you're interested that I showed you earlier, the seller concessions cheat sheet that I showed you, and so this is the same QR code you just saw, and Spencer, oh, nice picture.
Yeah.
So this is who I use to do my video work. And he's amazing. Just watching him work on the software and stuff, he's so good. I mean, he does it for a living. He's done a lot of movies, and so he's trying to break into the real estate world of listing videos and stuff. So that's why he's offering first video for free. You can see the quality of work that he does, and then use him for your promotional videos that really, will help you to stand out amongst the crowd. So, that's his info there. And I think that is, oh, great.
Awesome.
So, thank you. And I hope you got some good tidbits there.
Any questions? Or anything?
They already.
Dude, there was probably about 3 dozen talking points in there. You guys should use. Maybe you want to do a reel on it, to do a post on it. Engage with people, start a conversation. One of the greatest things to hear from somebody is like, I didn't know you could do that. And you're the guy who told them, right? They need options. Like she was talking about this person that's under contract with another agent or whatever, and they've got this contingency or whatever. She probably doesn't know there's another option, right? Or they could have eliminated that altogether. So great conversations, and some of these need to happen way before you even start going look at houses. Because like the person, you sat next to somebody at the Chamber of Commerce, they had a plan based on their knowledge and their experience, and whoever they had talked to, get 6 months out, and then they talk to somebody else and get new information, and they're buying a house. So super cool, great content.
Thanks.
Can I share these slides with these guys?
Yes,
the slide deck?
absolutely.
Just as a refresher and stuff. That little chart was really, really cool. It was a